Hello everyone, welcome to the new video on 3-minute series for prelims. In this video, we'll be discussing about capital adequacy ratio. The capital adequacy ratio CAR or the capital to risk weighted asset ratio CRAR are prescribed in the Basel norms by the Banking for International Settlements. This is a grouping of central government, finance ministers and the banking regulators which meet every year for strengthening the banking industry and the finance industry in the world. The Basel norms are prescribed by Basel Committee for Banking Supervision, which is a subcommittee under the Banking for International Settlements. So far they have prescribed 3 Basel norms, that is Basel 1, Basel 2 and Basel 3. While Basel 1 and 2 mainly speak about the capital requirements, Basel 3 speaks about a lot of other requirements, which we'll discuss in the next slide. Before looking into the Basel norms, let us look at what do you mean by the capital adequacy ratio. It is the ratio between the capital, that includes both Tier 1 and Tier 2 capital, to the risk-weighted assets. Tier 1 capital is also called the core capital, and the component in the Tier 1 capital is the paid-up capital, while Tier 2 is called the supplementary capital and one of the component is called the revaluation reserves. Let us understand capital adequacy ratio with an example. Suppose this is the balance sheet of a bank where it has a liabilities of 95 rupees, that is, the bank collects deposit from its depositors to lend it to in the form of loan to earn an interest in that. Therefore, the deposit form 95 rupees and in the asset component, it has a cash reserves of 20 rupees, loans of 50 rupees. It has invested in government securities of 10 rupees and other loans of 20 rupees. Now, the risk of losing the cash which it has with the bank and the risk on the government securities is 0%. That is, the government is sure of getting this money at any point of time. But in the case of loans and other loans, the risk is 100%. That is, the bank may or may not get all the amount invested or given in the form of loans. Therefore, the risk-weighted asset is 70 rupees in this case. There is an accounting equation, that is assets is equal to liabilities plus owner's equity. Here we can see that the difference between the liabilities and the assets is the owner's equity, and in this case it is called the core capital. Therefore, the capital is 5. Now the ratio, that is CAR, comes out to be 5 divided by 70, which turns out to be 7.14%. But according to the Basel III norms which are prescribed by RBI, the capital adequacy ratio should be at 9%. Therefore, to increase the ratio, either the capital should be increased or the denominator, that is the risk-weighted asset, should be decreased. In this way, RBI ensures that there is minimum capital in a bank in the form of capital adequacy ratio to ensure that even in case of losses in the banks, the bank can continue its activities without being liquidated. The other provisions in the Basel III norms are counter-cyclical capital buffer and the capital conservation buffer and the leverage ratio. Please pause the video and solve for this question. Consider the following statements. CAR is the amount that the banks have to maintain in the form of their own funds to offset any loss that bank incur if the account holders fail to repay dues. CAR is decided by individual bank. The correct answer is A. As we have discussed, the statement 2 is wrong as the CAR decided by the RBI and not the banks. Thank you.